Greetings, everybody. This is Jeff Scott, and welcome to this week's edition of my top-down review. Let me get everything set up, and let's go ahead and get started. I'll just start off by saying that I'm sure you've already looked, but the market does not like uncertainty, and right now with the debt ceiling craziness in Washington, you can see futures are set to open up almost 100 points down on the Dow, over 10 on the S&P, 15 on the NASDAQ, and 9 on the Russell. I don't think anybody should be surprised about that. The issue will be whether or not they quickly reverse, if there's any positive news, and how deep they would drop should we not get any kind of a settlement. I'm not political. I'm not going to be political in this thing, but a couple of thoughts that I have is I felt the same way in December, and we've had the best run that I can remember in the market, despite the things that have been happening. And although the sequestering was so horrible, and we heard a lot about it, and I'm not discounting the fact that for certain industries it's problematic, it still looks like there's still growth in this economy. Maybe they need to double the sequester and get to the point where eventually they'll have no choice but to start addressing some of the issues in the market. But again, I'm not going to be political. I'm not political, and let's move forward. Quick PowerPoint, as always, basically called today, Debt Ceiling Showdown Looming. I think it's almost here. Here's my contact information. HighGrowthStock.com is my domain. Jeffrey, my first name, so Jeffrey@HighGrowthStock.com. Disclaimer, as always, this is for educational purposes only. Anything I recommend is only in the spirit of education and should not be considered investment advice. Do your own research. I'm a physician, not a broker, and most physicians lose money with their investments, and I am not affiliated with any software vendor or trading company. Any tools I demonstrate are those that I use in my daily trading, and I paid for all the tools that I demonstrate. Basic agenda, look at last week and then look forward using top-down techniques. For bottoms-up investors, a couple of great shortcuts, and then a very quick chart review. I have a lot of different programs. I switched to a different computer for tonight, so we'll see if it works smoother. It wasn't a software program. I got so much on the other computer. But basically, I need a real-time trading platform, whether it's TradeStation or Thinkorswim. I need an analysis program, which I think HGSI is the best. EdgeRater is a great supplementary tool. It uses HGSI data. It's great for backtesting. It incorporates the Connors ETF trading with an ETF bandit. And I'll look at it today because Chris added some neat tools incorporating with my friend George Lee's trading techniques. I do believe in seasonal analysis, although I don't spend much time with it on these broadcasts. I refer you to magentatrader.com, and Derek Pilger has a number of free webinars there. And I like MarketSmith. It gives me better earnings, not better than HGSI from a validity perspective, but it gives me longer term. But what I really need is to take with what I've learned from my, quote, gurus. One of the most important things I learned from one of my favorite gurus, Ian Woodward, was he said to be your own guru. And so I've developed my style based upon the things that I've learned and the impressions made upon me by many of the folks that I have here. Ian and Ron of Woodward and Brown Investing, Alexander Elder, Van Tharp, Position Sizing and Money Management, William O'Neill, the godfather, I guess, of growth stock investing, and then if he's the godfather, then these must be his children, Morales and Katcher, who have really taken O'Neill's disciples and discipline rather, and took it to a new level. And then I use Bigelow for candlesticks. I highly recommend that you read the majority of books on this as you start to build your trading skills. Gronke is probably more tailored to those that are retiring, that are looking at a way to generate income with covered calls and naked puts. It's a very sensical, simple way of approaching with a nice software package to support it. Pascagoula, it's conceptually, it's an interesting story. It's about the role of big volume and the institutions and moving stock prices. I incorporate a lot of the tools from that, but I've moved to a different way of measuring that. So the websites are there. My approach to trading, I always get asked this. First thing is I have a number of different accounts. Some are actually more, I won't say buy and forget or buy and hold, but they're positioned. Most of them are swings. I swing trade stocks and options on equities. I usually measure my time frame in 1 to 2 weeks, but sometimes I may be much longer. I do day trade when I have time, but I found that it's hard for me to day trade stocks. I'd rather day trade futures and their derivatives, and about the only time you'll see me today buying and selling a stock on the same day is when I had a really bad buy. My personal favorite trade is whatever time frame, find something that's been in a long-term uptrend and has pulled back to major support. I love earnings, and I guess that's because I'm a growth stock guy. And so I like to buy stocks that are growing, and I like to see earnings growth even better, higher than the price to earnings ratio that my stock may have. Once I find a stock that meets my criteria for a setup, so that the pullback to long-term support and good earnings growth, then I'm going to look for a trigger. When I make my trade, I know my target and stop. And as you probably know from before, I've used almost every program on the market. I end up using just a couple. Top down versus bottoms up. The market controls the majority of what a stock will do tomorrow. The sector is the second most important thing. And as much as I'm a stock picker at heart, it's really going to be determined by the market and the sector. So, for example, any stock that we look at today with a hint towards going long is likely to get trashed tomorrow in the morning. And that's because the market right now is going against it. I also, as I do my analysis, I like to find groups of stocks within a specific industry breaking out at the same time, and that gives me further affirmation or confirmation that I'm making a good choice. Now, I also bottoms up invest. Even in a bad market sector, there are stocks that are leaders to the upside. In this approach, you fish from a much broader basket of stocks. You might catch moves earlier. Often I get the same stocks as in a top-down. And what I find that the difference for me between top-down and bottoms-up is I may get some home runs on the bottoms-up that I might not have seen before, but I also have a lot more strikeouts. So it's a higher risk way of doing things. Over the weekend, I start with numbers of watch list. I take the best of stocks from Metastock scans, VectorVest searches, IBD, MarketSmith, and HGSI scans, and I build a watch list of about 500 stocks. And then I run that through some automated trading with OmniTrader, but also try and look at every one of those charts. That is clearly bottoms up. As the week goes forward, and also on the weekend, in about 15 minutes I can go from a top-down approach, which is much shorter than it takes me to do the bottoms up. So I'll do the bottoms up and top-down over the weekend, and during the week I'll do purely top-down and then a couple of shortcuts on the bottoms up that I'll show you tonight. A couple of comments. This seminar is coming up October 26th. It may be Ian's last. There's always hints around that. It is a bargain. You will learn a ton. Information on the website. Website there is highgrowthstock.com. And just for the sake of completeness, sorry about that. I said it's a new computer, so I'm finding a few things here or there that I haven't done yet. So let me just get this done. What you want to do is to watch me install Flash, but it looks like it should be done here momentarily. So here's the website for HGSI. First thing up here, notice you get a free trial just by hitting that button. It's 30 days, no credit card needed. I have a lot of old movies. If you have interest under investing strategies on my blog here, which I will be posting more and more things to during the market, and to links to my YouTube site. Ron Brown will also post shorter posts, but more often, mostly about the market, about HGSI itself, and integrating HGSI with other programs like TOS. I'll do more stock specific. Ian has a blog which is viewed by people from all over the world. Last one updated was a couple weeks ago. Ian updates him when he thinks the market's going to change or under entropy, so it wouldn't shock me to see something soon from Ian. A couple of other conferences I want to let you know about. As I said, I use Magenta Trader for my seasonality. And if you go to magentatrader.com and you look under workshops, there's an upcoming workshop in Las Vegas the week of Sunday, November 17th. It rolls right into the meeting of the Traders Expo of Vegas that occurs the same week. George Lee will be one of the headliners there. I'll be speaking as well. And then I don't have a link to it, but Greg Mills, and if you email me, I can help you out. Greg Mills is holding a meeting the weekend before the HGSI Summit in October, in a couple weeks, in Orange County. And Ian will be giving a 1.5 hour presentation. Gil Morales will be speaking there as well. And for those who are in the area, it's probably worthwhile to attend that. If you are local and you have the interest, you might want to stick around and go to the Palos Verdes meeting as well, and you'll get, I can assure you, some great exposure. All right. Enough of that. Well, it's taken a long time on that. Well, so one of the first things that I like to do is understand what the market did last week. And it's important for me before I start to go forward. So the first thing I jumped into is TradeStation. Because TradeStation, I look at my elder indicators, and specifically today I'm just going to talk about the color of the bars and the MACD histogram. So the first thing is, if I look at the peak here, and we had a higher high here, we did not take out the higher peak on either the histogram or the line. So on the S&P 500, we're still dealing with MACD divergences, which would suggest downward pressure on the market as we're seeing. And you could see we actually painted a red bar on the S&P 500 Friday, which is a signal on the elder indicators that you should not be buying. On a weekly and a monthly, we're green and we're blue. But pulling back in the midline would not shock me to see it pull back down to that bottom envelope, which is at about 1650, would be another 3 or 4% from here. So elder indicators suggest to me that I don't want to be going long, at least beginning the market on the S&P 500. The Dow Industrials, boy, is this computer faster. You can see we painted a number of red days, and that this is in a market that's falling. And again, also concern about some bearishness there. And the NASDAQ, which is probably the strongest of the bunch, and last week I think the NASDAQ actually traded flat while the others were down. You can see the NASDAQ still painting blue, green on the weekly and monthlies, but it too had a divergence on the MACD, and something that might be concerning as we look at where we're going in this marketplace. So at least my start of my analysis is this market still looks like it's tough, and it should have been a tough week. Now, the interesting thing is it wasn't such a tough week for me. And I think when I say me, I could really point to those that trade on growth stocks or high growth stocks. If I look at last week and I measure either from Friday to Friday, end of day Friday this week, or from the beginning of the day Monday to the end of the day on Friday this week, I get about the same response. The first thing I know is that if I look for the S&P 500, the S&P 500 was down 1% on the week, 1.06. So that's what I usually look for, and my goal is to outperform. And when I'm not outperforming the S&P 500, I'm a little bit nervous. So a couple things I notice. First thing that I might notice is that there's a lot of black, which means there's a lot of positive groups here. And in fact, if I was to guess, there's more positive than there are negatives. So despite all the negativity in the market, there were a lot of well-performing groups. Specifically, my holdings, if they were not traded, and I just kept what I ended last week with, would have been down, or would have been flat, minus 0.04%. So basically, a nothing week from my previous holdings. Not to say I keep those holdings, as I said before. Had you looked at Friday's IBD 50 and just bought all those stocks Friday before the market closed, if you had access to it, you would have been up about 0.5%. If you were able to run the HGS stocks scan before the end of day, and the HGS 100, the top 100 or so HGSI stocks, you would have been up 0.64%, so outperforming almost 2% by the market. If you were like me and looked at it on the weekend and just bought the stocks that you identified, the stocks that I listed and showed you last week were up 2%. So growth stock investing was up for the week. So despite all the negativity, it wasn't a horrible week. Now, what were leaders? Pullbacks and coiled springs, so stocks that have pulled back, so things that meet my criteria. So 3 pullback-related items right at the top, including one scan that I run that was up 15%. Just curiosity, what were those stocks? JKS and Pinnacle Entertainment, the big mover there being JKS, one of the ones that we talked about last week as a junior solar. That looked well. So pullbacks seem to work. Bible gap ups, as usual, were up 2.32. Breakouts, again, seem to do well, up 2.2. Bongos were up. Best of Woodward and Brown were up. Let's see where that Best of Woodward and Brown less than $10 was for the week. That's been one of my favorite scans of late. This week it just performed about the S&P 500. These numbers are almost the same. If I look at end of week, my buy watch was up a little bit less, 1.8%. The market opened up lower. My stocks have been down 0.1 for the week, and S&P 500 was down a little bit over 1.1, down 1.15. So large stocks underperform, growth stocks and small stocks seem to outperform. All right, where we are with bucketology. Bucketology shows me that 70% of stocks are trading above the Bollinger Band midline. That is on the bullish side of things. And as I look at bucketology, I don't see a preponderance of stocks at the top of the Bollinger Bands anymore. And that's nice to see and suggests that we are not in a place where we're horribly overbought. Which, by the way, we were about a week ago. And when you're horribly overbought, you typically sell off. When you're horribly oversold, you see a lot of stocks down here, and you typically rally. So we're in the middle, leaning towards bullishness. Did we see any new Hindenburg signs? We did not. And remember, the Hindenburg is a mathematical calculation that has been associated with every major market meltdown in the last 50 years. Typically, you're looking to see several of these occurring at a top. We had a bunch of them occur in August, but we haven't seen any in over a month. I had mentioned last time that I was looking for us to get a double top, perhaps, from back up to the August tops, and then potentially get some more Hindenburgs telling me that a sell-off was imminent. This is a funny time of year. September is the worst year for the market, although we can all think about some of the horrible market corrections that occurred in October. September is actually a worse month. We know that Syria remains volatile. We know that the debt ceiling is an issue. On the positive side, we have Iran and the U.S. talking. So it's going to be an interesting couple of months. But once we get through the middle of October, we do get to a much more seasonably favorable time of year. Next, I'd like to jump into HGSI. And within HGSI, start to look at where we are and where we might be going in the market. So I'm going to go down here to Woodward & Brown user groups, Major Markets Plus, top down, which is looking at several weeks, technical only. I could see that the NASDAQ is leading. No surprise, we saw that before. I noticed that volatility is making a comeback, and you could see the VIX was up 10% on Friday, 18% for the last 5 days, and where the market is right now, it's likely to be even higher next week. The weakness in the market, gas, utility and transports, the industrials, the NYSE, the stock market's on the weak side. Over 5 days, the strengthening, volatility, bonds. Gold was actually kind of up almost 1% for the week, and the small stocks were the best, but as you can see, as we already talked about, the S&P 500 was down over 1%. So I know I'm going to see weakness when I look at these indexes, so we'll look at it very quickly, make some comments, and move on. This is the S&P 500. I'm not going to go through my typical work, but to, pointing out multiple 3 to 4%. This one from top to bottom was closer to 8%, 4% pullbacks, and one could argue that we're just pulling back again as we've done, and we'll bounce, and perhaps we'll pull back again to the 1660, 1670, and run again from there. And that at the end of the day, we'll have another 4 to 6% correction. We haven't had a big correction in quite some time, and perhaps you could argue the market is overdue. And except for Thursday, we were in the midst of a multiple-day sell-off last week, which I'm sure you're all well aware of. If we look at the Dow Jones Industrials, you'll see a similar picture with a deep pullback here in July, and a similar picture as the S&P 500. If I look at the NASDAQ, it looks a little bit better. You can see we had a very shallow pullback, and then actually a higher open than the close, although down for the day on Friday, but certainly more resilient and stronger. Look at the relationship of the S&P, the 50-day moving average in blue compared to the other two. The Russell 2000, again, looks a lot like the NASDAQ. Again, going back to the S&P 500, and my point about the 50-day moving average, you can see we're getting much closer, where on the NASDAQ, if anything, we've sort of went sideways and not in the process of pulling back. Looking at volatility, which we mentioned, had a very strong week, and you could see that we actually on Friday with a kahuna popped above a squeeze of the major market moving averages. It'll be interesting to see whether or not we can get above this declining tops here, or will that become resistance? Now, the interesting thing is, as you can clearly see, every time it's run up, it's very quickly pulled back, and this is going back to the beginning of the year. So is this just another one of these where it'd be painful for a couple of days and then we'll pull back below the 200? Or, in this lovely comment, is it different this time? And a lot remains to be seen on that, but enough to keep our beady eyes looking at it. Gold and silver, I guess with some of the concerns in the market, a small rally over the last couple of days, not much of a rally, but actually traded up for the week a little bit less than 1% in a deep downtrend. Hard to get excited by gold and silver here, although at some point in time they will start to rise. I guess the low risk phenomenon is to wait for them to break above the 200-day moving average. Some people might say that if they hold the 50 and go up from here, that this might be a safe place to buy with your stops below the 50-day moving average. I like to then look at some of the, we call them the eye charts, but take a look at some of the market internals. So that's for the broad market indexes because those are calculated and not reported. And let's look at the S&P 1500, which just for the sake of discussion looks like the NASDAQ. Lots of little pullbacks, the 50-day really being an area of support, some porosity seen in a number of places, but has held. Go down to the eyes. You can see that on the DI plus versus DI minus, the plus is turned down. Could be an early sign of weakness. If we look at new highs and new lows, we still are above the 13-day exponential moving average of highs versus lows. Cumulative, from a buy-sell signal, we're still with more new highs than new lows on the bottom. If we look at accumulation, A through E, we could see that the dark green is still pointing up, although it's much lower than than we'd like to see. For the A's, the B's also look okay. The D's and the E's turning down. The C's also turning down. So most of the movement this past week almost was the C's turning down as much as anything else. Looking at A versus E, you could see still going the right direction, A above the E, and we're right at that 10-day exponential moving average of the A's and B percentage. And as I've said before, when we drop below that moving average is when we see market weakness. So this is a look at A&E. We got advanced decline line, and then the up-down ratio, the 21-day ratio in brown. So that is clearly making lower highs. So you have some divergence there with a rising market. If we look at any recent days of 5-to-1 advanced declining issues or volume, this would have been the previous week, so none of those. So we still see strength in the market, but a lot less strength than we were looking at a week ago. And you could see that the number of stocks in the S&P 1500 trading above their 20, 30, 50, and 200-day moving averages have dropped and are starting to get negative below their respective moving averages, which is also a negative sign for the market. So enough signs of market weakness. How about from the top down? I want to look at the industries. I want to look at what's working now. I look at the force up. So my 146 becomes 29. If I look at those that are doing poorly, it is 47. So that's a clear drop over the last several weeks. Again, more evidence of weakness coming into this market. So I like to go through the top 10 very quickly. Broadcasting, these are all the three of these charts on the top, and even stars made my buy list. This is a clear area of strength in the market. Let's just take a quick look at some of them, and I'll comment about it. Now, if you've downloaded everything and you go into HGSI Strategy under Chart Review, it's under my name. And this is the view that I like to use, and I like to bring in. And basically, I'm looking at earnings per share growth on a quarter-over-quarter basis and revenue growth. I'm looking at bongos, accumulation, distribution, and force, momentum indicators. I'm looking at green candle lows and red candle highs and the high jump here. I'm looking for Bible gap ups. I'm looking at DI plus minus crossover. Here is your standard candlestick charts. I use an 8-day exponential, a 17, a 15, a 200 simple day. The blue ones are pocket pivots up. The magentas are pocket pivot down. Can't remember what, I think my group strength is in this as well. Let me look at this real quick. This is the group index. You can see if the group is going up or going down. Over here I've got two volume windows. Why do I have two? Because often my volume is obscured by my signals. The top volume has red and green. These are green are Eurekas, red are Phoenixes. These are the plus and minus follow-through day like equivalent in HGSI. On the bottom we have kahunas, and these are momentum indicators on whatever instrument I'm looking at. So Sinclair Broadcasting, major uptrend, 12 up to 34 from the beginning of the year. Continues to run. Everything is green. Didn't like the earnings per share growth, which I thought was uninspiring. It was negative. And I will jump into MarketSmith for that purpose alone to take a little bit more broader look at earnings when I have a question about them. And what I saw here, like most of the entertainment stocks, was 2013 as a stub toe, and then major growth coming. So if they deserves a PE of 20 and it makes $3 in 2014, then this is potentially a $60 stock. The problem with growth stock investing is if you miss your earnings, you get clobbered. And if you make your earnings and lower expectations, you get clobbered. So earnings growth is a double-edged sword. It's wonderful unless you miss. Clearly breaking away, good earnings ultimately coming in, lots of group strength. Next are almost the exact same pattern. They both had a shallow pullback here, coming up off a squeeze here with the 8, 17, and 50 together, running again. You can see earnings per share starting to come back into this stock. Entravision is a cheap stock. They own a number of Spanish-speaking stations. Looks like it's a couple weeks behind the others with that shallow pullback. Broke above the 50, a DI crossover, earlier buy, cheap stock, nice earnings per share growth. I find that one to be interesting. And then the other one that I liked in here was called Stars A, and you could see lower left, upper right, shallow pullback, handle, and running off to the stars. Everything is green, great earnings per share growth. So you probably ought to be owning one of these. They seem to do well, even with the volatility in the market related to our government. Insurance, I've been in and out of Homeowners Choice. I got scared off because I thought that its earnings per share growth was going to come to a hold. And this was a mistake. I should have stayed in long in the stock. But you could see great earnings per share, but growth is slowing down going into next year. It continues to make new highs. Certainly is a lower left, upper right leader, and one that remains very attractive. You want to buy these obviously closer to support. That's why I like buying pullbacks. So Homeowners Choice looks attractive. Genworth, a little bit less of a run, not as impressive on the earnings per share growth. Next group is biotech, one of my favorites. I mean, some of these are, I don't want to say they're luck, but some of these are stocks that are have revenue, growth, stable companies. So my favorite in that category is Celgene, and people know I'm a major Celgene bull, although I'm probably going to sell half my position up here because it's run up so much. I've sold some calls against it, and I'll let them get called away here. I hope they get called away because it will be a nice position, a nice run. You could also argue that Celgene's about to start another leg up, handle, volume coming in on Friday with pocket pivots, kahunas, everything is green. And they're really hinging on some European approval of their lead drug Revlimid. Why would I sell a stock here? Because I'm long from the 20s, and it's the #1 position in my portfolio. And if they get turned down in the EU, the stock's $120 again. So I'd rather book some profits. If somebody said, Jeff, what's tomorrow's Celgene that they should be buying? big company with revenue and stable, I would say buy Gilead. Similar pattern, earnings per share looks sick here, but it's only a short period of time of earnings weakness. In fact, if I look out a couple of years on Gilead, I see some major growth coming back into the stock. If the stock truly makes $3 of earnings in 2014 with earnings expansion, even if it keeps the same multiple, drops, it's going to be a $90 stock. Gilead's been a leader in HIV. It's going to be a leader in Hep C, and they're getting a footprint in oncology. So those are the ones that I like the most. The best stock to have owned in this category, and one that is obviously expensive right now, is Regeneron, up near about $300. We've talked about this several times. It just keeps going higher and higher and higher. Then you get the ones that are leaders up here. These are mostly small companies that don't have any earnings or revenue and are really story stocks where they're driven by news releases, data releases, investments, and takeovers. I don't know Omeros Company, but it had a huge shooting star on Friday, and I would not be too interested in that. I have been in and out of Celdex. I wish I never was out of it. This is on a major move, clearly not driven by fundamentals from an earnings per share perspective, but rather driven because of hope on a number of their lead compounds. Probably, in my mind, a little late for jumping on board. A lot of targets around 40. You want to buy stocks like this in an uptrend on pullbacks to moving averages. Don't know anything about Diex, but it looks like the first one. Some revenue, no earnings, big move up, sort of like a flagpole. If I saw it give a pennant, I might buy a breakout above the pennant formation. Another biotech that I don't know much about, but as you can see, a big move. So I personally prefer those stocks that are have earnings and revenue and marketed products, but you can't ignore things like ISIS. Some revenue, no earnings, and just continuing to move to all-time highs. So when people ask me what I think about these individual biotechs, it's really hard to comment on these small ones. I own a number of them. One that I've owned that has a little bit of earnings and looks a lot like Celdex. In addition to Celdex, I've owned NPSP. A nice move there as well. And again, none of this is based upon earnings growth. There's always stories here, and these are fun stocks to have in your portfolio, but you got to have a limited number because you have to expect many of them to fail. Right now, some are working really well. Automobile manufacturers, can we say Tesla? Sorry about that. I want to right-click on that, change index group. Now, interesting thing is Tesla still had a good week, up 4%. When you're a $190 stock, that's $7, $8. But interesting that in an economy that is supposedly not doing great, the manufacturer of Winnebagos and other recreational vehicles. This is Thor, and you can see a pretty deep pullback. Bunch of pocket pivots coming in here. I'm not sure that counts as a handle. It's a little bit too short. But big run up, sold off, running again. Everything is green. And then Winnebago itself, a similar pattern, not perhaps as pretty with a little sharper sell-off. But notice those kahunas, Eureka Day coming in at the bottom, and then it ran. And Tesla, what a beautiful picture. Lower left, upper right, pretty straight shot. Total momentum play. Again, just like those biotechs, if you have no earnings and you start moving, it's driven by emotions, it's driven by excitement, it's driven by momentum. These stocks have a tendency to keep running. A lot of people thought at $90 the stock was oversold. You notice you had a great flag here, run up a hill, flag here, you broke above the top of the descending flag line, and you're ready to run again. These momentum stocks are great. You just don't want to be the last person off. Oil, gas storage, these were down on the bottom, but you could see some of the shipping stocks and some of the transportation, the piping stocks have made a comeback. So Knightsbridge Tankers, I spotted them a couple weeks ago. They pulled back here. They had a nice little spike up. Certainly in an uptrend since July. Everything is green. Not really exciting on an earnings per share basis, and pays a huge dividend yield of 6.9%. Eagle Rock Partners, this must be an MLP. Yep. Pipelines they own. A move up off the bottom, most important, a 12.2% dividend. So this is buying a stock that is beaten down hard. You're getting a great dividend yield. Probably be subjected to what the bond market does. Cheniere Energy, LNG, no dividend yield, growth stock. Don't necessarily like the earnings per share here. So I don't really know much about MLPs and pipelines. I've bought these occasionally when they're beaten down because I like big dividends and there's a 10% dividend play. Probably need to do your homework on this group. Wireless telecommunications. Pretty deep pullback here to the 200-day moving average, running up again after Kahuna volume came in, DI crossover and a Bible gap up. Have no idea what NTLS does. They've got some earnings growth coming into the stock. I like to see that. They pay a 9.2% dividend. Another group in the top 5 that's all about dividend plays. Does that tell us that bonds are going higher and dividend and interest rates are dropping? That's what we've been seeing. Wireless communications. All right. We got United States Cellular, similar pattern, deep sell-off, nice run up here. And I guess a lot of the sell-off was related to the fall in bonds and rising interest rates, which killed the group before and this group. Vodafone, probably now a buyout candidate, recently got a big cash infusion after selling its stake in Verizon Wireless, 4.4% dividend. So this group and the last are probably all about dividend plays. Movies and entertainment. It's got to make something to show for the broadcasters. And several of them I like here. What a neat chart for Live Nation. Concert promoters. You know, I like this chart for a lot of reasons. You went sideways for a couple of months. You've got pretty good support. Right under the current price, you've got 3 moving averages to support you. You've got a lot of group strength, the DI crossover, Kahuna back here. It's not too far gone yet. Earnings per share are a little strange. Let's take a look at this, LYV. Something that one of the gurus said that I actually think made sense. I killed my, or I'm not going to go into MarketSmith, I killed it already, and said that earnings never made anybody money. And that's already baked into the chart. So fundamentals matter, but if you're a technician, you believe they're already in the chart. It's a nice pattern, sort of a saucer pattern. Maybe it'll give us a handle before it runs. Maybe it runs from here. I like the base after a beautiful run-up. Don't know this group whatsoever. Good earnings per share growth after a turnaround. Ugly looking chart, however. Lionsgate had a pretty tough pullback to the 50. This has been a good area to buy this high flyer in the past. Probably a good area to think about it again. You see the stubbing the toe here. It's a sector where this was known to be a tough year, I think, for a lot of these stocks. IMAX, would you have liked to have bought it on the pullback to the 200-day moving average? Uptrend. Hard pullback. I probably would have got into it back here when it broke above the 50 when these major moving averages were squeezing together. Nice run, probably a little bit late for my taste. What else looks good? Number 8 was healthcare equipment, driven here by a takeout of Mako Surgical, which makes robotics. So we don't really care about this stock. I don't know if Rockwell's the one that bought them. I'm not sure who bought them. This is another medical device companies. And the interesting thing here with these guys is with Obamacare, they're paying a 2% tax on their medical devices. Now, one of the things that the Republicans are trying to get repealed in the House is that 2% tax on the devices. So if, perhaps, that gets repealed, you might see a run-up in the stocks that make any kind of healthcare equipment. And then you'll have companies like Cardinal Health, which has a large medical insert supply division, who might also run up, perhaps, if the 2% tax is taken out of the market. Not that exciting here. This was an interesting one. Don't know anything about the company. Medical electrotherapeutic apparatus. Saucer base, kind of a flat handle, a bunch of kahunas volume, gap up with a Bible gap up, everything turned green. Love the chart. Don't know anything about the company. It's on my buy list because of the chart. All right. Go back. Oil, gas exploration, some of the big ones. I've been a big pusher of the little guys. So as I look at this list, I see a lot of stocks that I like. Down on the bottom is Triangle Petroleum, and maybe 2 weeks ago I was all over this one, and you could see it was breaking out above the 50 when I got excited by it, and it had a huge run. Notice the earnings per share growth on Triangle Petroleum. Cabot Oil and Gas, this one is a little bit easier to buy right now. I'd like to see it get above the 50. I've got a position in this one. I should have sold out when the things above turned red. Great earnings per share growth continuing. Recently split 2-for-1 if you're thinking that it's supposed to be a $70 stock. Chrysler, another big mover. Great earnings per share, small company, lower left, upper right. Very, it became relatively tight up here as it continues to run. Probably should have some of these in your portfolio. Here's a bigger one, Pioneer Natural Resources, PXD. And again, you can see lower left, upper right, pretty tight chart. No dividend, multiple of 50, but a very substantial growth rate. One of my favorites that I've been talking about is Kodiak Oil. And to me, this guy has made a dramatic change. If I look at a weekly, you can see the stock did nothing for about 18 months or 15 months, and is now broken above its previous, and looks like it wants to go higher, and it's got the earnings per share growth, I believe, to support it. Whiting Petroleum, some bids came in the market about potential buyout. Got a doji at the top. So I let that settle out before I jumped in. It's very extended. You can see it's at the top of its high jump bar. And Oasis Petroleum is another one. Again, they all have beautiful earnings per share growth, relatively small stocks. And I went backwards on this list, but I've been picking out stocks I know. And Magnum Hunter is another one. MHR, big move up. Couple kahunas, huge volume over the week on Friday. Cheap stock, $6 stock, and I believe it becomes profitable soon. So I think it'd be nice to own a couple of those. Hopefully you already do. You pick the one you like, but this $100 WTI and above that we've been seeing for months, ultimately I would think nothing has to happen. Ultimately is likely to reflect itself in some high prices for these small oil plays. Specialty stores, see a mixture of different retails, Tractor Supply, Ulta doing very well. Take a look at the first couple, see if anything looks interesting. Office Max gone sideways, all the moving averages came together in a squeeze. Kahuna moving up, everything is green. Don't like the earnings per share growth. I know there's some mergers in this sector. I don't know if they're in a buyer, acquirer, being acquired, or just a competitor of who's being acquired. Vitamin Shop, the bottom fish. PetSmart, Pocket Pivot, huge day on Friday in a bad market, all green. Makes money, but not a whole lot of earnings per share growth. Hibbett Sports, it's down around the 200. Not too interested in that one yet. GNC Holdings, I won't shop there, I don't think, General Nutrition Centers, but lower left, upper right, looks good. Pocket Pivots, pull back a little bit, something maybe to consider. And then I look at the last one, which will be that was number 10. Let me see if there's anything else here to comment on. Big Pharma, if you're a value guy, you might want to look at Pfizer. Why would I want to look at Pfizer now? Because maybe you want to buy Pfizer when it's cheap, and it's cheap now. It's down at its 200-day moving average, broke above the 50. If it holds at 50, then that might become nice support to grow off of. Had a DI crossover, Kahuna on Friday, mostly green except the longer weekly bongo. And another thing nice about Pfizer pays a 3.3% dividend. Anything here that I like? Yeah, there's a couple here that are some of my favorites. Whoops. That one. Lanet, I always thought this was a newspaper, and I read it. It's a drug company. Great earnings per share growth. Stock is, it's kind of high jump territory, but it's got great earnings per share growth in the sector. Certainly extended. Probably don't want to be in it right now, but if the market pulls back, it might be something to get into. Remember, I'm looking for growth at a discount. There's no discount on this one yet, but you may see a discount coming when this market sells off, which many people, including me, think might happen. Activist, this is the old Watson, a generic play. I think so is the last one. Base on a base, I guess. Taking off here at Kahuna. A little bit of a gap up on some volume on Friday. It makes money, all green. I think Activist would be a nice holding. Warner Chilcott is about to be bought by Activist. Santeris, which has been one we've talked about a lot in the past. Big run up, a little deeper pullback than I would like to have seen. A couple of Kahunas at the bottom. Had a DI crossover down Friday, but I'm expecting this thing to run back up, but it'll have some resistance at its 50-day moving average around 24. Acorn woke up on an acquisition and looks like to me like it wants to run again. First stage breakout, second stage breakout. So perhaps there's room to go. It makes money. Would like to see a bit longer base. Had a nice Kahuna there. In Jazz to me is the quintessential stock of what I like to buy. And I know Bruce B. on the board has been in the stock a long time, as have I. And let me see if I can try to get a specific picture. This is a stock that right now it's just in a super run using the 17-day moving average, pulling back there again here, so it might be a buy opportunity. It makes money. It's in the land of Big Pharma where there's not a lot of earnings per share growth. It does not, I believe, pay a dividend, 0.00%. Recently moved to Ireland, which makes it tax efficient and also potentially makes it a takeover candidate. And this is just a great run from 57 up to 90 in the last 5 months. And this is what I want, pull back, sort of a shallow saucer, a bit of a handle, and then boom, a nice run. Late in the game, look, perhaps. All right, any other groups that I'd like to look at? And then probably my favorite in the market, I guess I should look at two more. Valiant, pulled back a little bit, looks a lot cleaner, frankly, than Jazz. Like Jazz, has good earnings per share growth. This guy grows by acquisition, and our most recent acquisition was Bausch and Lombs. I'm at 56 minutes. I'll probably go about 15 more minutes because I got to go watch The Good Wife with my good wife. I guess I skipped by it. Another one that looks like it might want to run again, I can't tell if it's pharma or biotech, is Alexion. Broke above the 200-day moving average here, pulled back to the 50. I just get the sense it's going to run again. Had a kahuna, everything is green. So to me, that's about what I do for top-down. I look at the top 10 groups and see if there's anything else I want to see before I move on. So I would take these stocks, put them in a group, and then I watch them when the market opens Monday, and I put them in some automated trading platforms, and hopefully I make money. Now, as I mentioned, I mix top-down and bottoms-up. And the reason I do that is because in a down market, there still might be some stocks that are moving nicely, and it gives me a broader base to fish in, but I recognize from the bottoms-up perspective, it's a little bit higher risk. So I do a couple of quick things on the bottoms-up approach that I'd like to show you. One is looking at a specific search called sprinters, and the other is using the group inclusion filter on the smart groups. So if I go to warehouse, change this to all securities, put my favorite view on, we'll just call it scorecard no index, and then I want to take off the filter to start with. I see that I have 7,855 stocks in my database. Scorecard no index is a balanced, fundamental, and technical powered ranking system, and it finds the best stocks. Now, one of the problems with what I just did by taking off my filter is I get a lot of cheap stocks. Here's $1.73, 50 cents, 15 cents, 78 cents, and volumes that may not be very robust, 68,500, 13,000. So I'm not able to trade most of those. So what I do is I take that list and I put a filter on it. And the filter that I usually use is, I'll just go into scorecard, do a next filter, okay. And then let's look at my filter. And my filter is already eliminating things I won't touch. So it's above $5 and above 150,000. Now I've been following some folks, George Lee and others, and clearly there's money to be made in lower priced stocks. To me, the risk tolerance might be different. And the big problem for me with lower priced stocks, if I was to take a $50,000 position in Pfizer at $30 a share, I'm buying 1,500 shares. If I decided any time in the future that I want to sell those 1,500 shares, I do a market order, I don't move the price of the stock, and I'm out in a heartbeat. If I take one of those stocks with 5,000 a day or 10,000 a day shares, it's a dollar stock, and I buy 50,000 shares because that's my position size, how many days is it going to take me to get out from that stock? And what do you think the market makers are going to do to me? I'm going to buy it, I'm going to sell it at the bid, buy it at the ask. There'll be a massive spread, and I lose money. So I'll take those 7,000 stocks, put my filter on it, drop it down to 2,874. So one of the first things that I might do is just look at the raw ranking here, raw combo of the scorecard, and I could see what some of the best stocks in the market are. And many of them we've talked about or already looked at. So just looking at strength of the stocks, let's look at that combo here. Locate top stocks to trade based on both technical and fundamental factors, strong earnings, revenue growth, strong relative strength, group rank accumulation, ROE. So this is a quick way, and I can look at the top 10 or 20 stocks and find some things that look attractive. Now look at the groups. Auto manufacturers, biotech, pharmaceuticals, broadcasting. These are the same groups that we saw in top-down investing, although you have other stocks making the list that weren't there. There's the specialty stores as well. One of my favorite views, if you go up here into HGSI strategies, Woodward & Brown top-down investing, archive, reference library, go down to miscellaneous, you'll see something that's developed by my buddy David Ghilardi called Sprinter One Step with Bongos. And basically what I'm doing here is I'm ranking stocks. They have to have a white body, so they went up for the day. They have to make money, revenue per share, have to have good volume versus 20-day moving average, high Wilder RSI, earnings to price increasing, positive force, Bollinger percent B, higher the better, high raw group, high industry performance, high slope, high growth rates, high O score, which is a fundamental score, and high accumulation distribution direction. So it's all very bullish characteristics, and frankly, they're a mixture of fundamental and technicals, but there's a lot of technicals on that one. And what this is going to find is now 86 stocks, of which these are high, some of the best stocks in the market right now. So all I would have to do, if I didn't have much time, is come home, open up the warehouse, put on my sprinters, and take a look at the top 20 and 30, and I bet I can find some things there that are worth buying, and many of those are ones we looked at already. If I want to take a little bit more time, I can say, let's do a thing called group inclusion filter. So one of the things that the program does for us is it does some canned searches on your HGSI strategies. It looks for things that had, from Morales and Catchpane, Bible gap ups, pocket pivots. It looks for several best of Woodward & Brown, best under 10, criteria, so many different things. So what I'd like to do is hypothesize that if a stock, if these are lists of very strong stocks, then if I have a stock on multiple lists, it must be a really good stock. So I go into Tools, Group Inclusion Report, and I identify which groups I want to look at. So I hit Clear. I want to look at Bible gap ups, look at pocket pivots, and then a bunch of Woodward & Brown groups. I want to look at best ofs, best under 10. I want to look at demand, best criteria, ERG, growth, HGS 100 leaders, QEPs, stocks and groups moving to the upside, and strong EPS. I want to make a group from it. We're going to call it Web Gems. People have been here before. I do this every week. Frankly, I do this every night. We're at 9.29. I only want to look at the top 10 that I find. It could be less when there's ties. Hit OK. I'm going to hit this. So what it's finding for me are the stocks that made it to the majority of the list. So we'll rapidly look through these top 10 and see if there's anything there we're going to like. So this is bottoms up, but there's some overlap from what we saw in top down. Now I'm going to go back into HGSI, into the designer. I'm going to find that group. Just looked at. And let's take a look at these very quickly and see if we found any stocks that looked attractive. Celgene we already mentioned, looks like it's breaking out again. It's had a huge run. As I said, I'm taking profits, but I do love the stock in its performance. A couple kahunas in a pocket pivot on Friday, wants to run again. Energy Partners, this is an E&P play. It's had nice earnings per share growth, but starting to slow down. I have position in this one as well. Entravision, we talked about it, the Spanish broadcaster. We looked at Sinclair, and Nexstar looked even better. This one looked earlier. In Ian talk, this I guess is, we could say it's about to, let's see, crossover. It's 405. I mean, it's a viable stock right now with your stock below the 50-day moving average. Icon PLC, Life Sciences. It's a nice looking chart, lower left, upper right. Pullback, looks like wants to run again. I put this in the category of clinical research organizations. Covance, Coraxel also made my big 500 this week with some strength. Lithium Motors, if autos are strong, you've got to sell them somewhere. You've got Ashbury Automotive, CarMax, and others, publicly traded automobile retailers. Big run, lower left, upper right. Been talking about this one for a year. I don't get this company. To me, it's kind of like Herbalife with skin preparations, multi-level marketing, and I'm afraid of it, except you can't argue with $35 to $100 in less than a year. Great earnings per share growth. Been nice to buy it on pullbacks to the 50. It's sort of getting extended. Regeneron, as I mentioned, was a high-flying biotech. The reason why this one keeps going higher is multiple. They got great drugs, they got great pipeline, and they got a great big company called Sanofi that owns a big percent and is going to buy more of them. Someday we'll take them out. Don't know much about Repligen, but we talked about it last week. I said I'm buying it because sideways to the 50, all I needed was a signal, and I got my signal on Tuesday. I had a volume in a kahuna, broke above the 50 the day before. Another biotech doesn't make money, but I love that when I see that long consolidation. Storm Ruger, these are guys that sell some pistols. Won't say much about them. A lot of news driven on this company. Winnebago, we looked at before. So that was a quick way. I'm going to end tonight by putting up my buy list, and then let's take a look very quickly, rapid fire, through what's on my list. So since you can pause if you have interest, you can pause and write them down. I make no guarantee, and I'm going to go through them very quickly and tell you why I picked them and what I'm looking for. And your risk tolerance and everything else may be different than mine. So if you want to look, stop and look. I'm going to start moving very quickly, and since many of these we've already seen, we'll go very quick. Winnebago, we've seen already. A leader, pullback, running again. Celgene, we've talked about. It comes up every time we talk. Nexstar is one of those broadcasters with earnings coming back in. Pullback, a little late, but running nicely. Icon is that clinical research organization. Sinclair is another broadcaster. Tesla, lower left, upper right. What a move. This is momentum. You stay in it as long as it meets your criteria. Don't be the last one off the ship. Entravision, that Hispanic Spanish owning television networks, looks like it wants to run, or stations rather. Mercado Libre, the South American eBay. You know, it's a pretty beautiful cup it just made here. Is this a cup and then a handle? That'd be a funny place to have a handle. But it looks like it wants to run again as well. But it's getting extended. Lithium Motors, we already talked about that one. Here's that Alexion. I just get the sense that it wants to run off of here. Had a kahuna on Thursday, all green on a bad market. It was up on Friday. Valiant is one of my favorite pharma stocks, which I have a substantial position in, lower left, upper right. So does Bruce B, I bet. Activist, we talked about this, the generic maker. Base, and then another base. Looks like it's ready to take off, makes good earnings. SoFund Holdings, this is one of a Chinese internet play. I think they're in real estate on the web. I did sort of a funny position on these guys. I bought the stock on this pullback, but I really didn't have great conviction. But what I liked about it, and I probably shouldn't even have this conversation now, is part of me wants to worry about return and safety. And what I saw was so fun was a huge premium. Now, it's been a little while since I bought it, but the same thing still exists. So let's say I'm interested in SoFun. And let's say I want to buy 5,000 shares. That's going to cost a lot of money, obviously. That's about $250,000. But I don't want to take it. I want to take very little risk. So I'm going to go out into November, and I'm going to sell 50 calls. This is basically the trade I took on it. So I basically, for 48 days of rent, I'm going to get paid $5.30. So what I'm looking at is over a 10% return on this position in 48 days. Now, if the stock goes to 60, 70, 80, well, I gave up a lot of potential money. If it goes to 43, 44, I broke even. If I analyze this trade, what it shows me is my break-even point, as I said, is about 44. The most I can make on this trade is $32,000. And my requirement for margin was about $100,000. It's not sexy. It's not that exciting. It's not even that interesting to probably most of you. But you know what? I'm getting a yield, a huge yield. I'm making over 10% on my money in less than 2 months. If you can make that over and over again, obviously if the stock bottoms from here, I'm going to sell the stock and I'm going to cover my calls and try and get out without getting hurt. But I can't resist that play, and I've made this over and over again. Do I think the stock is going to go much below $45? No. And that's why I did it. So I'm basically rolling the dice. I'm going to take 10% return for 48 days of holding the stock, a stock that's in an uptrend, that makes money, and has been a darling. Again, I have stops in it. If the stock breaks my stop, I'll cover the stock and the calls. Gilead, we talked about. Owen Financial, this is one of those companies that services the mortgages. They've been doing well. Their concerns have been around growth and what happens if there's no mortgages for them to buy. Let's speed it up here. Kodiak Oil, we already talked about. Triangle Petroleum, we already talked about. Fab Universal, not for the faint of heart, but it's a small Chinese company, and it had a run-up from $4 up to $11.50. It's now at around $7.50, $8. It's got some earnings coming into the stock. If it truly makes 15 and 28, it's 43 cents. Plus 25 is 68. Plus another 20, almost $1 a share. It's probably worth more than $7.50 on a growth stock. And I put it on to watch it. It's a little dangerous for me. We talked about this medical technology play, MVDQ, with the Bible gap up. Talked about Santeris and a pullback on the pharma. AFOP is a fiber optic company. Every time it's pulled back to the 17-day, it's run up again. It pulled back on Friday. I think it's still compelling. We looked at live entertainment. Trina Solar and JKS are my favorite solars, as is CSIQ. Too bad you didn't buy it down on the 50, but these things are in launch mode. And I think it's an industry story. Here's Canadian Solar. Great earnings per share, makes money, taking off, not overly extended. SunPower, another solar, looks just like the same chart, makes money with good earnings per share growth. Centene is a managed care provider. It was on my list last week, had a big move up. I think these guys would be a big winner. Whether Obamacare comes or goes, they have a lot of Medicaid and Medicare business. NSN, that's like OCN, great earnings per share growth, not as attractive a chart. Facebook, you know, as I say every week, you probably need to own some Facebook because it looks to me like it wants to be a Tesla. Bit Auto is a small Chinese website, auto trading, good earnings per share growth. Looks to me like it wants to run up from here again, great group strength, everything is green. Stars is another one of the entertainment companies, long base, running again, makes money, good earnings per share growth. Himax is a technology play, part of Google Glass. Google has an investment in them. It's got a flag here. So what do I do on this play? Well, I already own some, but I'm looking to buy more. You know, I'm not a great drawer, but let's say my flag looks like that. When it breaks above this line, I think about buying more. Intermune, don't know much about this. It's one of those biotech stocks, I believe. Pull back, going sideways back to the 50, which to me is always a great time to jump back in. A lot of people did on Friday, don't know much about the stock or the company. Nike had a Bible gap up. Something's going on in the shoes. Skeecher's another one that looked interesting with earnings per share growth. Here's JKS, another one of these solar stocks, great earnings per share growth, probably the leader of the industry. These are all small companies. Infoblox, here's that picture where I talked about you had your flag. And what happened? You broke above it on Friday. To me, you'll get 60% of this move from here up. So I'm interested in that one. Jazz, we already looked at. Pilgrim Pride, I don't get the chicken market, but I like basing on the 50, great earnings per share growth. For whatever reason, it doesn't seem to get much attention. You probably need to do your own research on it. FXCM is a futures broker. Several of them made it to my reporting. It's got some earnings per share growth. Again, I love these sideways formations. Then it had a bullish engulfing day and a kahuna and everything green on Friday. Here's Skeechers, pull back to the 50. Looks like it wants to run again. Great earnings per share growth. Acorn we talked about. Method Electronics, MEI, is a electronic converters company. Been watching this one in and out of it for some time. They do some defense and auto work. They make money. Not a big stock. I'm going the wrong way. Great earnings per share growth. Cheap stock in my mind based on that earnings. Micron, we talked about this for 3 years. Just a total change in company related to change, I think, in the market and less competition, running again. And I think I'm getting near the end. Here's Pioneer Resources, one of the E&Ps we talked about. Here's a financial play, TFS, which looks like it's breaking above its descending trend line. Broke above the 50 with a kahuna and big volume on Friday. And I think that's enough. Here's Vistaprint, sideways with a kahuna on Friday. And I'm not going to go through the list anymore except to look at Avis as an interesting stock. Pull back to the 200-day moving average. Makes money, had a big day off of it on Friday. When it jumps above that 50, I'm probably going to jump in. Got earnings per share coming in. Last thing I want to show you is kudos out to Chris White and George Lee. In the new version of EdgeRater, actually has a George Lee signal template. There is a way to run this intra-market to update it, but basically you can actually look for, here's the all securities list. It takes about 3 minutes to run this. Stocks that are in squeeze, and I can look for breakouts or breakdowns in a squeeze. So here's at the close of the day, these are all the stocks with mobile breakouts in a squeeze. Here's PSAR breakouts in a squeeze with a pocket pivot. So let's just look at BGR. That should be a nice looking chart, at least one that broke out nicely. And then I want to say goodnight. There was a webinar on Magenta Trader tonight that was free where George Lee, I think, was going to talk about this, and I'm sure you can find it on their website. And here's that BGR. I'm not going to pay much attention to it, but breaking out from the squeeze. So that note, I think I covered all that I said I would cover. Have a great week. It's going to be probably a challenging open for the longs, unless you bought protection at the end of the week like many of us I hope did. And we'll see you again next week or so. You all have a great week. I'll continue these weekly as long as there seems to be demand. You all have a great week and good night.